Hello, and welcome to this week's edition of Tax in 10 with me, Rachel D'Souza, and Andrew Robbins. We are both tax partners in RSM's London office and have a wealth of experience in dealing with a wide range of private client matters. Your feedback is valuable to us, so do keep it coming, especially if you have thoughts on any topics you would like us to cover. You can contact us by email, and our email addresses are at the bottom of your screen. Now, Andrew, I wanted to talk today about a situation I have recently been dealing with, which got me thinking about the way we approach problem solving for clients. Now, some of the details of this are very specific to individual circumstances, but I think there are some broader points to take away about how we bring our expertise to assist clients in devising bespoke solutions for their problems.
Excellent, that sounds interesting. I hope it means that you're coming around to my way of thinking about creating planning solutions that are so clever that even I don't understand what I'm suggesting. So tell me more.
Well, the situation our client faced was actually quite typical. His father had shares in a holding company of a trading group and is at an age where dealing with that group on a day-to-day basis is just really getting too much for him. So he plans to give the shares in the holding company to his son. Not surprisingly, the son wants to know what are the tax implications for him on receipt of the shares, and how does he actually go about extracting value from this trading group?
Okay, so let me think about this. Depending on the group, it sounds like we might have a capital gains tax implications on the gift, inheritance tax if the father dies within 7 years, and then tax payable by the son when he wants to take money out of the business later. Is that about right?
Yeah, absolutely. Although in this particular case, the father was non-resident and non-domiciled, and the shares were foreign property. So in fact, we could narrow our focus because we didn't need to look at the IHT aspects from the father's perspective. The son was far more focused on the increase in his UK tax liabilities following the gift, and as I said, how to extract value from the group, which was also about to have a liquidity event.
Right. So often in my experience, what happens at this point is a conversation about going non-resident, because it always seems to be the first thing that my clients consider. And then I end up spending time trying to get them to think rationally about moving abroad and what it actually means, and whether the tax saving is worth the upheaval. So what happened in your case?
Well, so interestingly, that wasn't the case here. My client is very down to earth and he's settled, he's married with a young family, and he's got his own career in the UK, and he really doesn't want to go anywhere else. So we needed to find a solution that worked for him, sort of based on him being here in the UK.
Yeah. So what do you come up with?
Well, as always, the starting point was to determine what the position would be without any planning in particular. So in this case, very, very broadly, as a UK resident and deemed domiciled person, receipt of those shares would be tax neutral. Although, of course, the value in those shares would then fall within his own IHT estate. From an income tax perspective, he could take money out of the company by dividend or by salary, but of course, both options would be subject to income tax. So neither was particularly attractive, especially, from his perspective, as the profits have been built up over a number of years entirely outside of the UK, and then, would become taxable in the UK as he extracted. So my thoughts turned to whether there was something better that we could do. And the thought was triggered by the CGT analysis of the receipt of the shares, because of course, for CGT purposes, the son would take those shares at the market value on the date that they were gifted to him. So obviously, if he sold those shares straight away, there wouldn't be any capital gain. And I felt that this would provide us with an opportunity to do something with them.
And when you say doing something with the shares, what do you have in mind?
Well, if he sold the shares to a personal holding company, leaving those proceeds outstanding as a loan, then the profits could be extracted from the trading company to the new holding company in a tax neutral manner. Because the holding company owes him money, he can then request a repayment of part of his loan, which would result in him being able to access those funds in a tax neutral way.
So because we're not paying tax on the way into the company, your arrangement would allow your client to take out a tax-free amount over time, equal to the whole of today's market value of the shares, basically.
Yeah, exactly, that's right.
So what does that do from an IHT point of view? Let's say if we assume that the existing shares would qualify for the business property relief exemption.
Good question. The easy part is that the shares in the new holdco should qualify for BPR after the usual 2-year holding period. But we do need to think about that director's loan. An outstanding director's loan account will never qualify for BPR, so that would be a problem. However, there is a neat solution in the form of issuing redeemable preference shares instead of using the contracted loan. In this way, the son will end up holding ordinary and preference shares in the company, all of which do potentially qualify for BPR.
So that solves the IHT problem, but redeeming the prefs can actually be quite complicated in my experience, because the hoops you have to jump through under company law. So I guess there may be a trade-off between the tax advantages in that case. I mean, it sounds like in some cases, at least, you may just have to choose between tax-free access to the loan or BPR on the shares. I suppose one solution is just go part and part, or actually just insure against the potential HT liability.
Yeah, that's right. And the wider point here is that it's really important to think about the bigger picture. The solution I came up with for the client is quite different to what he was expecting. And if we had just followed his lead rather than thinking a little bit further outside the box, he could have ended up with a much less attractive result. And it's one of the things I talk to junior staff about a lot. You know, it's the need to understand why clients are asking the question, not just to jump in and give them an answer, although that approach is really important for giving good tax advice. And you can pretty much apply that to most things in life, I guess.
Yeah. However, before you steal my thunder and get too philosophical on me, let's draw a line under that. And do you have a recommendation to finish with?
Oh, I do actually. So back in about 1992, bear with me on this one, I read a book which was called Wild Swans, and it's by Yung Chang. And the book tells the story of 3 generations of Chinese women, Chang's grandmother, her mother, and Chang herself. And the book opens with the birth of Chang's grandmother in 1909 and concludes on September the 12th, 1978, when Chang, who is then a 26-year-old scholarship recipient, leaves Peking to begin her studies in GB in the UK. And I remember being absolutely enthralled by her story back then. And I have to say now, I'm thrilled that my 13-year-old daughter is reading it. So that's a very long way of saying, if you haven't read it, I thoroughly recommend Wild Swans by Yung Chang.
Fantastic.
Fabulous. All right then. Thanks everyone for listening. As always, please let us have your comments and feedback, and we can be contacted on rachel.d'souza@rsmuk.com and andrew.robbins@rsmuk.com.
Bye.